Hey everyone, my name is Jack. Welcome back to the channel. This is another episode of my M1 Finance portfolio series where I'm trying to reach a $100,000 portfolio in this platform, M1 Finance. I cover a variety of topics as they relate to personal finance on this channel. However, every month I like to break down my specific holdings in my M1 Finance portfolio so you can kind of see some of my moves in context as well as understand more about my own investing philosophy. If you like that sort of content, be sure to have a look around the channel, and if you like what you see, be sure to subscribe. I'd very much appreciate your support. But believe it or not, it has been one full year since I started this series, all the way back in February of 2020. Those were definitely different times when it came to the stock market, especially. That was just weeks before that catastrophic crash we had in March that was quickly followed by a very, very strong recovery, much of it totally driven by government spending and the Fed put and all that great currency devaluation that came with it and all the exuberance that has followed. But in that year, I learned a lot about investing, especially about stock investing, and I've really fine-tuned my own stock investing strategy from where it used to be a full year ago. Even though that is kind of a long time, it really isn't in the grand scheme of things with investing, but you really can learn a lot in a year, especially a year like 2020 where things got pretty crazy. So I did make a lot of changes to this portfolio. In every single episode, you can actually see the portfolio I had at that specific episode, at that specific time. I always include a link to it in the description. And with M1 Finance, one of the nice things about it is you can actually copy other people's portfolios. So if you want to copy mine, I'm not a financial advisor, it's certainly not advice, but if you want to use it as a start or maybe for some inspiration to learn about what you should research next, then maybe you could go ahead and do that. I always include it in the link below, trying to be transparent here with what I'm actually investing in, and so you can see it for yourself and maybe it's helpful for your own portfolio. But as of the filming of this episode, I'm down to 19 positions. I think I started with something like 90. I'm going to go over my original portfolio and see how things have changed, since there have been quite a few changes from way back in February before the initial crash that has followed with this huge rally. But 19 positions, very concentrated compared to what it was. Now, this isn't all of my stocks that I have in my entire portfolio. This is just M1 Finance. I even have another M1 Finance portfolio off to the side here that is invested mostly in international ETFs and a lot of gold and silver stocks, though it's not as big as this portfolio. And I also have my Roth IRA at Vanguard, which is totally in index funds, but again, that's much smaller. I think that's $10,000 compared to what we're at about 44,000 plus about 3,000 in cash, so we'll just call it 49,000 or so, almost at that $50,000 mark, and almost $10,000 in gains. I think I eclipsed it over last week. At the end of the week, I had $10,000 in gains at one point, which was kind of cool, but we're back below that. But oh well, you can't really control what the market will do in the short term. But the majority of my portfolio is in these 19 holdings, and you can see full breakdowns of it with actually a plurality of that majority being in these four stocks, that being Equity Commonwealth, Turtle Beach Corp, Pershing Square Tontine Holdings, and CVS. When you put them all together, that makes up something like half of this portfolio. Now, there are larger holdings like in metals over here. I have a lot of gold and silver sort of hedging against inflation, and also just a place to park some cash while I kind of wait for other opportunities. I don't really see these as super long-term holds. It's more of a swing play over maybe a few years, and just to have my money working as opposed to sitting on the sides in cash. I do have a fair chunk of cash already, but I think the only thing that we've learned in 2020 is that cash is not always very great to hold. It's great to have liquidity for sure. You want to be able to jump on opportunities as they come, but man, it really hurts to hold things in cash when you have this much inflation, when you have this many returns that you could possibly make with actually solid investments, not just overpriced ones. I'll get to that in a second. But here's my original Duffley Ventures portfolio. So all the way back in February of 2020, this was the portfolio I was running with. We had 50% in this slice right here, that being, if it ever loads, that is. My internet has been a little spotty recently, which is a shame. And here it is. Half the portfolio was in these three holdings, these three ETFs, broad market ETFs, all US focused, total stock market funds, small cap, and value. And it's just very passive index funds inspired by Ben Felix, who does have a great YouTube channel. I would recommend checking him out. That was half this portfolio, very passive, as I was of the belief that passive was the best way to go and only way to go. And don't get me wrong, passive investing is a tool that should be used probably if you don't want to do a lot of due diligence when you're investing. You just want to have your money working and you don't really care about looking at companies and businesses and figuring out what a good stock evaluation is. Then yeah, this is probably the best route to go. And that was me back in February. And I'm not saying that I'm a huge expert or anything now, but I feel like I'm a lot better equipped, at least with my perspective now. I don't think this is the best strategy for me personally. That said, I do have some passive investing already. I'll probably always leave my IRA, my Roth IRA, as passive investing because I just want to have that sort of, you have a pretty good idea of how the market's going to do over the very long term. Short term, you have no idea what it's going to do. But over the long term, I would expect humanity to get more productive, for stocks to become more valuable, and for that portfolio to grow over time. So I'll put my retirement into that very conservative style investing, very diversified. That's just me. You might do something else, but anyways, for my active investing, I want to focus more on companies, individual businesses, as opposed to this very broad market approach, because the market now is in a very weird place. This is a chart of earnings per share versus the price of the S&P 500, and you can see what's been happening. You see here that the S&P 500 is the blue line, and that's the price of the market as opposed to earnings per share. So what these companies are earning relative to the amount of shares out there. So you'd want the earnings number to be higher if you're expecting the stock market to go higher as well, because stocks are businesses and businesses earn things, and those profits are turned into dividends or reinvested into the business to create more revenue streams and more growth, and that is passed to shareholders as well through capital appreciation. So earnings are the lifeline of a business, the lifeblood of a business, I should say. But you can see what happens when earnings fall. The stock price typically will fall. And you can see in the rare instance, at least in the last 20 years, we had the tech bubble. You could see that the S&P 500 was actually rising quite a bit quicker than earnings were. And then as earnings fell, the market dipped pretty hard too. And that was the end of the tech bubble. But it wasn't that exuberant compared to maybe now. You can see what happened in the 2008 financial crisis. Earnings plummeted, and so did the stock market, very closely correlated. Then you had sort of a divergence start to take place through the 2000s as things recovered mostly, at least in the financial markets. You could definitely argue that the economy has not really recovered, but anyways, sticking to stocks. Earnings per share and the price stayed correlated. As one went up, so did the other. But then you get this divergence here happening after March of 2020, when we had that big sell-off. Many businesses were shut down. Many businesses have failed since then. Earnings per share have fallen in many cases. Many companies are in a much worse position than they were before the pandemic started. That much is obvious. But look what's happened to stock price. Stock price has completely ignored this dip in earnings for the most part, outside of that blip we had in March. And meanwhile, earnings have not recovered. For the talking at a broad market basis, you could cherry pick counter examples all the time, which I'll also get to in a second. But you could see, just from a broad market perspective, it looks like the stock market is very, very, very expensive. Now, there's lots of metrics to look at. There's no one that's going to tell you this is exactly what's going to happen if X, Y, and Z happens. No one actually knows that. But if we're just looking at trends, this seems kind of dangerous. And when we're talking about investing and we're looking at the risk reward of investing, there's two sides to what makes a good investment decision. One is you're trying to maximize returns. That's obvious, but if all you were trying to do is maximize returns, then I would just do YOLO options bets and GameStop short squeeze type events. I would go for those things and that's it. I wouldn't care about risk. But there's the other side, and that is risk, the risk of losing your money, and you want to protect your capital as well. So it's in addition to maximizing returns, you want to protect your downside losses as well. Both are very important, and both serve a very important consideration to make when you're actually making your investment decisions. That's certainly the case for me. I've kind of turned a little bit away from maximizing returns and looking a little bit more towards protecting downside protection, because things are very exuberant. There are lots of places where you can make very fast returns very quickly, but who knows how reliable those are, especially when you consider earnings, when you consider the underlying businesses behind these very expensive stocks. So if we go back to my original portfolio, half of it was broad indexes. I think the indexes are quite overvalued if you had to put any sort of conclusion on it. Of course, I could be wrong because I don't have a crystal ball. We'll see what happens. It could go 10 times as high as it does now within the next year. Who knows? Lots of things could happen. But if I'm trying to look at things from a probability perspective, risk reward, I don't like it. So anyways, you can see I also had a lot in this New World Order Fund, as I call it. I do still have some of these. However, I had Tesla in here, which admittedly did produce a lot of returns, but it's grossly overvalued if you had to ask me now. And this isn't to say that it's a bad business. I think Tesla's a great business. I'm rooting for them the whole way. But good businesses can have quote-unquote bad stocks. Stocks can get overvalued, and when stocks get super expensive, that increases your risk. The risk is that money that you're putting on the table. To get the same share as before, you're spending more. As the stock's price rises, that makes it comparatively riskier because it's more expensive. Now you need more returns to justify that price. At least that's how people should be looking at it, but a lot of people don't look at it that way. But if we fast forward back to today, we can see that has been trimmed down to just 5 holdings. And I might actually get rid of Google very shortly and probably Alibaba as well. I just don't like some of the risk factors there, but I've been slowly trimming away at what I think are overpriced positions that, frankly, I think I just got lucky in. I invested in them very blindly. I was fairly blindly investing back in February of last year, but now I take a much more regimented fundamental analysis looking at a business. And you can see that that's at least mostly paid off so far. It's only been 1 year. I'm a long-term investor. I'm not what I'd consider a trader, but my big sort of long-term holds that I've already started have already done quite well. You have Equity Commonwealth, which I bought thinking that it was under what I'd call liquidation value. The properties that are owned in this REIT were worth more than what the stock was trading for in my analysis. So I bought it, and it looks like the stock price has recovered a bit, back up closer to quote-unquote fair value. So that's a good start. We'll see what happens as things move forward. Turtle Beach, another one, had no debt, bringing in quite a bit of cash, seemed to have some good tailwinds with console sales and things coming up, and it seemed very undervalued compared to that revenue stream, to that cash flow stream. So I went ahead and bought it. Same thing with CVS. Both have really skyrocketed, especially Turtle Beach in the last month. It's been huge, about 50% returns or something like that, because they just released their 2020 preliminary sales reports and the revenue numbers, and they're way higher than last year because they have a lot of good things going, and now they're in a much better position than they were before. And again, I'd say they're probably much closer, if not a little bit over fair value as opposed to before. But if they keep growing, then they might still be underpriced. I'm going to keep an eye on this one very closely because I'm definitely interested in potentially adding to this position because of this tailwind that they have right now. There's no guarantee, but I'm understanding the business more as I go. And then Pershing Square is the SPAC owned by Bill Ackman. This one I think is getting a little overvalued considering that it's just a cash vehicle, and who knows what it's actually going to invest in. I would assume it's going to be a fairly priced company that Bill Ackman and Pershing Square are going to pick, but you never know. It's a SPAC. This was kind of more of a place to park cash, but so far it's been a nice short-term investment, and we'll see how it does in the long term if they actually pick a company that I'm willing to stick around for. But when I talk about fair value, or what's often called intrinsic value, what the stock is actually worth, I wanted to actually show you something that Warren Buffett has talked about before, how he goes about valuing a stock, or at least a very general overview of what that means, what fair value or intrinsic value is. So here's his answer to that question.
Hello, Mr. Buffett. I got 2 short questions. One is, how do you find intrinsic value in a company?
Well, intrinsic value is what is the number that if you were all-knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of a business is. In other words, the only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about. Now, when you look at a stock, when you look at a bond, assuming it's the United States government bond, it's very easy to tell how much you're going to get back. It says it right on the bond. It says when you get the interest payments. It says when you get the principal. So it's very easy to figure out the value of a bond. It can change tomorrow if interest rates change. But the cash flows are printed on the bond. The cash flows aren't printed on a stock certificate. That's the job of the analyst, is to print out, change that stock certificate, which represents an interest in the business, and change that into a bond and say, this is what I think it's going to pay out in the future. When we buy, some new machine for Shaw to make carpet, that's what we're thinking about, obviously, and you all learn that in business school. But it's the same thing for a big business. If you buy Coca-Cola today, the company is selling for about $110 to $15 billion in the market. The question is, if you had 110 or 15 billion, you wouldn't be listening to me, but I'd be listening to you instead. But the question is, would you lay it out today to get what the Coca-Cola company is going to deliver to you over the next 200 or 300 years. The discount rate doesn't make much difference after as you get further out. And that is a question of how much cash they're going to give you. It isn't a question of, it isn't a question of how many analysts are going to recommend it or what the volume in the stock is or what the chart looks like or anything. It's a question of how much cash it's going to give you. That's the only reason. It's true if you're buying a farm. It's true if you're buying an apartment house. Any financial asset. Oil in the ground, you're laying out cash now to get more cash back later on.
That's all I wanted to show from that. Just this idea that what you're investing in with a stock is a business, and the business will produce cash flows, and the cash flows are what determine the intrinsic value of the stock. So the hard part is predicting what those cash flows will be in the future, and then you discount them appropriately based on what you're trying to get out of a return. That's different for every person. I usually use about 10% in my analyses, but it could be different for every company. Depends on the risk reward that you're looking for and how much of a steal, we'll call it, that you want to get on the stock. Since stocks are not always close to what some person might consider their intrinsic value. I want to go over one more example of this analysis, this whole intrinsic value versus fair value, a good company potentially having a bad stock or overpriced stock, and a counterexample. I'll go ahead and start with a popular favorite, AMD. Great company. I use AMD CPUs in my computer and I have for quite a while, and they produce a great product, and they continue to produce better products, and really they are a market leader, or one of them, in this space. They have great products. Great company, I would have to say. But their stock has dramatically risen over the last couple of years. We can take a look at their chart. Huge rise. Is this rise justified? Well, let's take a look at what the company's producing. Let's go to statistics here on Yahoo Finance. See, they are worth $113 billion. They better be selling a lot of stuff to see if they can actually meet that. You already have a red flag here of a price-to-earnings ratio in the 40s. Or this is a trailing price-to-earnings, but anyways, very, very rich valuation, probably. Good profit margins, nice 25% profit margin. That's not bad. Wait a second, they're only bringing in $10 billion in revenue, yet they're worth $110 billion, and that's only on a 25% profit margin? Hold on a second. That's a lot of money that they got to produce and grow in a very competitive space. There are other companies in this space. Even if they're doing great now, there's no guarantee that they're going to keep doing great 10 years from now. Scrolling down a little bit, we have $2.2 billion in cash. That doesn't really move the needle on a $110 billion company. And they do have a little bit of debt, not very much to change anything there. And they bring about $1 billion in operating free cash flow. Okay, so you have $1 billion in free cash flow, profits that can really be used to invest into more products potentially, that could be used as dividends, that could be used to do all sorts of things. That's it. $1 billion on a company worth $110 billion. That is an enormous valuation considering what they're actually bringing in. They would need to have spectacular growth over the next few years, really over the next couple of years, to even come close to justifying this price. If you had to ask me, of course, I don't know what the future's going to hold. I could be very wrong. We'll see what actually happens. But that's kind of what I'm talking about here. These cash flows need to rise dramatically for this valuation to make sense. And maybe it will make sense, you never know, but if we're looking at risk reward, the probabilities, I don't think it's very probable that that's going to happen, that this price is going to be justified. Maybe it'll go sideways for a very long time. Microsoft did something like that in 2000. It didn't actually reach its all-time high price despite growing profits the whole time until about 2016. So it took 16 years to turn a profit on Microsoft. You were sitting in the red most of that time, even though the company was producing great profits and was growing. So you got to see that it's not always about just investing in good companies, because good companies can have very expensive stocks and your portfolio might not do well over the long term if you're only buying very expensive stocks. That's not to say that you should ignore good companies even when they might be a little expensive. Depends on your risk reward tolerance. But let's compare that to Turtle Beach, the company that I invested in recently, and that's performed very well coincidentally over the last quarter. I'm not saying that I'm some god who knew that was going to happen this quickly, but it had some good tailwinds going for it and it seemed pretty fairly valued. So let's look at it now. So you have a market cap of about $500 million. I think when I invested, it was closer to like $300 million or something like that. But anyways, $500 million market cap. That's about what the business is trading for. Now let's compare that to its cash, $27 million. Not going to do a huge amount to move the needle. Pretty much no debt, and the cash can cover that debt easy. That wasn't very different from AMD. They didn't have a lot of debt either. And you see cash flows of about $40 to $50 million. It's actually going to jump quite a bit in this next quarter when they release their official earnings, but we'll just use this as an example. $50 million compared to $500 million market cap, total cash flow coming in at about 10% of what the business is worth. That seems to make a lot more sense than the 1% that you're getting with AMD, if you just had to ask me. And Turtle Beach, fine company, not bad. It's maybe not the market leader that AMD is, but does that really matter as long as it's a good company, good sound financials, good sound business strategy, honest? That's certainly a thing you got to look for. There are lots of factors to look at besides just whether you think it's good based on your feeling, but this is what I'm looking at. I'm looking at cash flows. You're looking at a business like it's a business, just as Buffett explained. You're looking at the present value of future cash flows. You're discounting those to see what a good deal might be based on its current cash flows. That's what you're doing when you're investing in a stock. And that is how I've changed my strategy over the last year. I've focused a lot more now on value investing, is what it's called usually, value investing, where you try to figure out what the stock's value is and get it at a discount to that value. And that way you can have fairly safe returns over the long term. That's what Buffett does. That's what Bill Ackman does. That's what Peter Lynch did and I guess still does. But that's what the great investors most often do. You have examples in the short term, certainly, that will do very great in 1 year because they had a lot of high-risk growth stocks that did very well, but you kind of have to ignore their other years where they weren't doing as well. This isn't to say that growth investing is bad by any means. It's still a very profitable strategy in times of growth and exuberance, for sure. You can definitely take advantage of that, and I certainly did. I had Tesla for a while, but I sold that off because it just got so absurdly valued, it didn't really make sense. It reached the price target that I would have imagined it reaching 10 years from now. So I'll go ahead and take the profits now in that case and put them in different opportunities to try and compound them. So moving forward, I'll be looking for more opportunities. I think as time goes on, I'll move things out of this metals slice since that's more of a place to park cash and try and take advantage of inflation, or not really take advantage, but protect myself from it. But I'm going to look for more value plays like Turtle Beach from a while ago and maybe even still now, like Equity Commonwealth, where the assets were worth more than what the thing was trading for, so I went ahead and did that, looking for those sorts of opportunities. And they are few and far between right now, if you had to ask me. Things are very frothy. I think that's not really very controversial, but that's kind of what I'm trying to do as the broad theme of my portfolio. I am focusing on value investing and will probably for a very long time until I am proven otherwise that it's not a viable strategy. I think it certainly is. There are other viable strategies, but that's the one that I'm going to go with for the future. But anyways, if you stuck around for the whole video, definitely like it since that would help the channel out a lot, and I appreciate you checking out the channel. And if you're new to this series, definitely consider subscribing so you don't miss any new updates, since I put out a new update on my M1 Finance portfolio as I try to reach $100,000. I do that every single month on the 15th, so I wouldn't want you to miss out, so be sure to subscribe. And if you're interested in this platform, M1 Finance, I do have some tutorials on it, and I can definitely include a link to that in the description below. And I also have an affiliate link to M1 Finance if you want to check out the platform for yourself and open up a free account. And if you use my affiliate link and end up funding it, I might get a small commission, which would help the channel out a lot. But until next time, take care.